You can see that back in January we got to the 200-day moving average, which is this yellow line here. We undercut it modestly most recently, so we've had a little bit more weakness. The good news is the number of 20-day lows you can see back here in January, which actually in this case was February, very close to where we are today. Or where we are last week.
This is the number of stocks that made 20-day lows.
Correct. Constituents within the S&P 500. And when that number swells, there's usually some type of stress, or what we call indiscriminate selling, and that tends to mark, at least very temporarily, some type of low. I think that's good news.
So we had a decent bounce back off that level. What about if we look at international stocks, excluding the US?
Yeah, so my bigger problem with this market, not that the trend is bad, but as you go and look at the longer term
get the second chart, guys.
The longer term picture of the MSCI World Index, X the US, that's a clear top formation. The 50-day moving average below the 200-day moving average. You've got the sequence of lower lows and lower highs. So we've got a US market that's in a positive trend, but globally our neighbors are not doing so well. And so that's, in our view, going to put some added additional pressure on the ability of the US market to maintain its uptrend.
I know we don't have a chart on this, so don't let's change yet, but is there a sense that this is an emerging market-led pullback, a developed ex-US market-led pullback?
It's a little of everything. It started in emerging, I think, because of the strength of the dollar, but if you look at Europe looks like it's under pressure. Most of Asia looks like it's under pressure, ex-China even. So, it's broader than that, and that's our concern, is it's not just specifically to EM, it's broader. In fact, I would say the top formations in Europe, in continental Europe, are some of the most disturbing ones that I see in the market today.